Welcome to our continuing series on the commercial real estate markets. I'm John Levy. This podcast is entitled Deer in the Headlights, and in it we intend to do two things. One, review current capital market trends, and two, offer strategies for raising capital when the capital markets are tight as they are now. As previous viewers may remember, our last podcast was entitled The End of Free Money. And although we didn't know it at the time, we were way too optimistic. Today, developers are hoping for not free money, but money that is both reasonably priced and reasonably underwritten. We've always said that Wall Street does panic better than anybody we know, and that's certainly the case now. In 2006 and 2007, Wall Street panicked, stepped on the gas, and we had an explosion of credit. And it was a lot of fun. What we're doing in the second half of 2007 is the panic is stepping on the brakes, and frankly, it's not nearly as much fun. It's difficult to describe the market today, but I think if we tried to put it in a couple words, it's like the deer in the headlights. Nothing's moving. The bid-ask spreads are extremely wide. Sellers, on one hand, think that the good old days of 2006 and 2007 are going to return tomorrow, and buyers, on the other hand, are sure that there'll be blood in the streets as there was in 1990, 91, and 92. We're not sure who's right, frankly, but what we do know is that the selling frenzy that we saw in 06 and early 07 won't be returning anytime soon. In fact, if you're selling properties based on pro forma, that's clearly last year's deal. Today, selling needs to take place based on actuals. In fact, actual financial statements are the real estate market's new thing. In 2008, we expect sales volumes to be dramatically lower. CMBS numbers, if they're a proxy for sales volume, well, before we go through that, you better reach for the Maalox because you're certainly going to need it. In 2007, U.S. CMBS originations about $240 billion. For 2008, we'll probably be lucky to get $100 billion, or a 60% reduction. Really, it's not quite as bad as it seems, because in 2004, the CMBS volume for the year was only $93 billion. So we'll be going back to 2004-like levels, but it'll be a long way from where we were in 2007. So if you're a real estate developer and you either need or want liquidity in this market, what do you do? Well, first of all, we suggest that you look at your portfolio differently than you might have looked at it in the past. As you know, in the past, when you were selling product or selling real estate, what you were looking for was property that either had no debt on it or had prepayable debt. All that's changed. Today, look for properties that have relatively new debt. And what you'll find is with the relatively new debt, it will either have below market rates or above current market leverage. That makes these properties extremely appealing. The process of assuming a loan today may be much easier than getting a new loan, especially in a tight market. And that means that the real estate closing can take place with more assurance. So when you're assuming a loan, that's especially attractive to buyers who are on a tight time frame because they're doing tax-free exchanges or so-called 1031s. With CMBS running at the lowest levels since 2004, many real estate borrowers are going to have to look to new sources for their loans. Perhaps the most obvious is the institutional market, populated by insurance companies and pension funds. We at John B. Levy & Company do an internet underwriting survey of 25 of the largest insurance companies and pension funds nationwide. Based on that, we can say that most of the participants are running at full tilt and now are producing new originations in the range of $40 to $50 billion, a far pace from the $240 billion that will be set by the CMBS industry this year. If you're unfamiliar with the institutional market, you'll probably first find that they will give you less leverage than you might have originally expected. But they're extremely good providers of short-term, say 3, 5, and 7-year debt. And the servicing is remarkably better, especially if you're used to the CMBS market. Additionally, for attractive and sophisticated borrowers, insurance companies and pension funds can offer a combination construction and permanent loan, where both the construction loan and the permanent loan are closed at one time and both offer fixed rates. In summary, consider 3 items. First, the market's just not moving. Buyers and sellers are not able to figure out prices at which they wish to transact properties. 2, if you're looking for liquidity, sell properties with new debt. And 3, if you're not used to it, get used to dealing with insurance companies and pension funds who are providing institutional grade financing. If you have questions or comments about this podcast or series, or would like to talk about a specific transaction or portfolio strategy, please contact us. You can reach us at our website, jblevyco.com, or by calling our main number, 804-644-2000. Thank you.